Howdy, Wall Street Willie. What are futures? Futures are a type of derivatives contract that obligate the parties involved to buy or sell the underlying asset at a fixed future date, called the expiration date, and at a predetermined price, the strike price. The underlying asset could be commodities such as gold, oil, etc., or financial instruments like stocks, bonds, ETFs, currencies, etc. Futures can be bought and sold on futures exchanges. Futures contracts specify the quantity and quality of the underlying asset and are standardized so that they can be traded easily on an exchange. For example, a futures oil contract would say that the issuer will sell the contract owner 1,000 barrels of oil for $75 per barrel on March 31st, 2024. Are there different types of futures? Yes, futures are categorized based on the type of underlying asset. Futures started as commodity futures, like agricultural futures, with the underlying assets being commodities like coffee, corn, wheat, etc. But now, they have expanded to other types. For instance, energy futures have crude oil, natural gas, etc. as the underlying, or precious metal futures have gold, silver, copper, etc. as the underlying. Also, there are financial futures that have underlying assets in the form of stock indexes like the S&P 500, or currencies like the US dollar, euro, British pound, or even cryptocurrencies. What are futures used for? Although futures can be used for buying or selling goods, they are most often used for speculation by traders, institutional investors, and funds, or for hedging by producers or manufacturers. Speculation involves trading futures with the goal of being able to sell them for a higher price than they were bought for. Speculators don't intend to take physical delivery of the underlying. The net difference is settled using their brokerage accounts. They therefore take advantage of the liquidity the futures market offers, as they can buy and sell based on their prediction of the price movements. Hedging is used to decrease risk by reducing exposure to price changes of the underlying asset. Hedgers are usually the producers or consumers of the underlying. Their primary goal is not to make a profit, but to protect themselves from losses due to price fluctuations. Taking a real-world example, a corn farmer can enter into a contract with a cereal manufacturer to sell 5,000 bushels of corn at $5 per bushel 6 months in the future. This helps the farmer lock in the selling price without worrying about any sudden fall in corn prices when he has harvested the crop and is ready to sell. Similarly, the cereal manufacturer can lock in the purchase price and not worry about a future spike in corn prices increasing his cost of raw materials. How are futures traded? That's a great question, Super Cooper. Watch the video on your screen to learn more. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend.